Too many clicky things. All right. So welcome everyone. My name is Tom Tanner. I'm with the Roanoke Regional Small Business Development Center, and I will be your presenter for the day. So what we're going to be talking about is the PPP forgiveness application. And what I will say, it's based on the information that's available today. And of course, like anything else with this PPP loan, it's like a moving target, is that the SBA dribbles a little information here and it comes out and changes, et cetera, et cetera. So what I tell you today is good today. What may be tomorrow may be a totally different thing. But we'll at least give you some good information. The bank is the one that's going to be requesting, that's who you're going to be turning your application back into. So they're the ones that they may require more or less documentation for your application process. So anytime that you have questions through this presentation, we have a ton of material to cover. I have a lot of slides on here that I'm not going to go over, but I'm going to send it as part of a reference, send it to you after this event so you have reference for it. We also have a spreadsheet, an Excel spreadsheet that will be sending out afterwards. If you have questions, we're going to try to answer them at the end. The ones I don't answer, I will put into an email with the answers so that you'll get this big packet, has all kinds of stuff with it. Also, you should have received an application, the actual PPP application. If you haven't seen it, here's the link if you need to ever download an additional copy of whatever. So, past my technical difficulties here. All right, so the first thing I want to do is go over just real quick to show you the results of what has transpired with this program, because I think it's interesting. So as of the 30th of May, throughout the United States, there's been 4,475,000 loans for $510 billion. And you will notice one thing I think is really cool is at the bottom there where it says lenders less than $10 billion in assets. So that's going to be your local community and regional type banks. And they are making up by far the largest amount of people or large amount of where people are going for their banks. They're also the largest amount of money that's being given out is through the smaller regional and local community banks, which is cool. Also shows Virginia. Of course, you can have access to this later on. Virginia has done 101,000 loans for a total of over $12 billion. Oops. The other thing that's really cool is that you'll see that 65% of the loans have been under $50,000. So that really ties into the small business community. And if you look at under 100,000, that's almost up to 80%. So you can see that most of the loans really are getting down to those small business owners. Average loan size is $114,000. And this just shows the different categories, and we're not going to go over that. So here's where we're at right now. So we had two bills, $349 billion and $310 billion. And as of 5:30, there was about 149 billion left, even though there's some commitment, so it's probably down to about 130. But there's still a lot of money left. If you know people who have not applied yet, or you're a business that has not applied yet, you certainly can. Unfortunately, if you already got a PPP loan, you're out of luck because you can only get one. So for anybody who hasn't been paying attention, the House passed a recent act called the Payroll Protection Flexibility Act, and this was just passed last week. This morning, the Senate said they will be taking it up and most likely will be actually approving the House bill, which is good news because that means they're not most likely going to try to create their own bill, and in turn will just approve the House bill. Now, whether it comes to be exactly what the House is, I don't know, but there's some really cool stuff in here. So I'm just going to go over this real quick so you're kind of updated on what's going on. For one is the borrowers can extend their 8-week period out to 24 weeks now, which is great news. Penalty calculation for the reduction in the workforce, which we'll talk about in a little bit, is actually, instead of being June 30th, it's actually going to be December 31st. So it gives you more time to try to bring employees back and still be able to take advantage of that calculation so you don't lose part of your forgiveness because of a lack of workforce. The biggest news by far for a lot of businesses is that the 75% test for payroll is going to become a 60% test, which means now you only have to have 60% for payroll and you can have 40% for non-payroll expenses. Now, the way I understand it is that what they call it is a cliff, which basically means if you don't have 60%, like if you have 59%, you're not going to get any forgiveness. So you got to have at least 60% in order to get forgiveness. Repayment terms has been extended out to 5 years. There is other programs out there. There's one program which you're not able to participate in now if you're in the PPP, is the payroll tax deferral, which is a 2-year deferral of your employer's share of the payroll taxes. And this now will be available if this passes like it is, so that you can also use that system too. The other thing that they did not bring up and was not passed was the deductibility of expenses, which has to do with the IRS. And I'll talk about that in a little bit. The other thing is that there's what they're calling a "we tried to rehire but couldn't really" exception, which basically means if you couldn't find qualified employees, or for some reason because of state restrictions or federal restrictions, you couldn't bring employees back, you're not going to be punished for that from the formulation standpoint. The other issue that a lot of small businesses have been dealing with is regards to bringing employees back who don't want to come back because they're saying, hey, I make a ton of money on unemployment. Why should I come work for you? I can stay home and watch TV. So what the VEC has done is come up and said, okay, if you've got employees that have been offered jobs but chose not to come to work, here's a website you can go to, report them, and they in turn will either come back to work or they'll lose their benefits. So basically, click on that link, it goes to this page here. Totally up to you whether or not you want to use it. It has no effect on the PPP process, which there is a way that it will not harm you. It gives you an exception if people don't come back to work, but it's not a requirement to do this. So this is the IRS notice I was talking about. I don't know if you're familiar with it, if you've heard people talking about it, but what they're basically saying is, hey, you got $20,000 worth of PPP. They forgave $20,000. Therefore, we're not going to count that $20,000 as income, where you typically would be required to count it as income, but we're not going to count it as income. But what we're not going to let you do is also take the deduction for it. So it's kind of like a double dip. So that's what that means by the IRS not allowing you to take the covered expenses, because you're already not being counted for the income. Now, there is talk in Congress to try to also allow that deduction. I'm not sure if it's going to happen. It's not happening on the bill that just got passed, and whether or not it'll get passed in a future one, because you really don't have to worry about the tax return next year. But regardless, that is something else that may come about. But for now, you're not able to deduct the expenses. So what's the process? So from the time that your covered period is over, you have 90 days to submit it to the bank. The bank has 60 days to send it to the SBA, and the SBA has 90 days to let you know. So there's a lot of days there working in the process. So if you're getting close to finishing up, the best thing to do is try to get this thing into your bank so you're not sending it in the same time these other 4.5 million people are, so that you can kind of get past to get it approved and done with. So a couple of things about if you're a sole proprietor or general partner or employee owned, there's a couple of things that you need to be aware of. So the employee owned, and this would mostly apply to owners of S corporations, owners of C corporations. The question that doesn't know, and this is another one of these cases where there's not enough information being provided, like an ESOP is an employee-owned company. Does that apply to this? If you own 1% or 0.5% of the company, does it apply to you? Or is it only like 20% and above, et cetera, et cetera? But if you're an employer owner, your cap, the amount of money that you're capped at is based on your 2019 compensation. And it's based on you taking your 2019 compensation, divided it by 52 and multiplying it by 8, or 8/52 of your 2019 total compensation. And that's the maximum amount that you can get, providing that's not over $15,385, which is the total maximum. But you can also take retirement and health care and add it into that. If you're a Schedule C filer or a general partner in a partnership, whether it's an LLC or not, you're only able to take the 8/52 of 2019 net profit. You are not allowed to take any contribution for retirement or health care. It's only if you're an employee only of a corporation. So, cool thing that we found out when this application came out is that in the beginning we were thinking, well, all this, your payroll is covered just during your covered period, and you basically only had that covered period to pay for your payroll. So what this came out with, and we'll talk about it a little bit in a minute, but it said you can pay for payroll during the covered period, but also during the period that's both paid and incurred. So in other words, if you have a payroll that is done, and I'll give you an example in a minute, that is covering a period prior to your covered period, but it's a standard payroll, you can cover it as part of your expenses because it's paid during that time period. You can also pay for people that are covered in that period, even if it's paid outside that period, if it's on your normal course of doing your payroll. So in the application on page 2, you'll see it distinctly says payroll costs paid and payroll costs incurred. So it gives you a case for both of them. So there's also came out this alternative payroll covered period, which is also a good thing because a lot of people, their loans started on the day that they received the money. Well, if they didn't run payroll that day, then it gets kind of screwed up of what's covered and what's not covered. So you're able to use an alternative payroll covered period, but you have to be on a bi-weekly or more frequent basis. So you either have to be weekly or bi-weekly for it to work. If you're not a weekly or bi-weekly, you can't use it, an alternative. So alternative basically means is that I can take a date after my loan's covered period and use that if it's my standard loan period or my standard payroll period. Just give you an example here. Let's just take this borrower has a bi-weekly payroll schedule of every other week. The borrower is 8-week covered period. This is a PPP week covered period. Begins on June 1st and ends on June 26th. So their payroll cycle doesn't start till June 7th. So the borrower can elect an alternative payroll period that starts on June 7th and ends 55 days later on August 1st. So what that does is allows them to keep their payroll system going just like it is, but still cover their employees. So in this case here, payroll costs incurred during this alternative payroll period covers them, but you also, if you paid somebody on June, so they're starting June 1st, so if their payroll period starts on June 7th and they did a payroll on June 6th, they could also cover the payroll for June 6th, even if they covered outside the covered period because it was paid during the covered period in the normal sequence of events, which is kind of cool. And this, again, it shows in the application process part of it. So retirement plans is another cool thing that you can do is that if you have retirement plans, let's say you normally fund them in December and you say, well, I'll go ahead and fund them now because if it's incurred or paid during this time period, you can count it as payroll expenses. So if you usually put $5,000 a year into a retirement plan in December, but you're saying, hey, I got the money now in June, I'm gonna go ahead and throw it in so I can count it as part of my payroll expenses. You can do that. So this has to do with interest, utilities, and the normal course of business. The number one thing is that whatever you're paying has to be in effect prior to February 15th. That means your rents, your lease programs, your gas, water, electricity, your internet, all of that had to be in effect prior to February 15th. If it was, then they're eligible for being covered during this period, whether incurred or paid for during this period. So if you have things that are paid for, like let's just say you started on June 1st, and you have your May electric bill coming on June 2nd, you can pay that and count it because it was paid in June. Even though it's for May, it still was paid during your covered period. And then if you have August come in, which is outside, you have July come in, which is during your period, but you pay for it in August, then you can also cover that. So in cases, you could actually get 3 months worth of coverage for during this 8-week period. So that's pretty cool. And the same thing applies to rent or lease payments. And I will say, because this is only part of the instructions here, it particularly says on line 2 about interest payments for mortgages. So interest payments would be for if you have a building or have lease payments or something like that. It says do not include prepayments. But line 3, where it says business rent or lease payments, in line 4, it says utility payments. It specifically does not mention do not include prepayments. So it implies that you can prepay rent, you can prepay other stuff if you wanted to. Now, whether or not this was a mistake and we're going to see something come out by the SBA tomorrow that says, oops, we made a mistake, that could happen. But for right now, that shows that you were allowed to make prepayments. So there's also this thing called the FTP safe harbor, so full-time equivalent safe harbor rule. And this has to do with making sure you have enough employees on staff. So if you lay people off between February 15th and April 26th, you have until June 30th to bring them back to full level in order to be able to count them as, to be able to get 100% forgiveness. Now, the way it looks is if this bill passed, that may even be pushed off to December 31st. So that's another change that could happen, that you may actually be able to wait to December 31st to bring it to full staff. Now, if you're at full staff by June 30th, you want to go ahead and submit your paperwork, then that's fine. You don't have to wait to December 31st. So the other thing is the 75% rule, which we've probably all heard about, 75% of it being used for payroll. And of course, that could change next week to the 60%, but for right now, we're using 75%. So I'm just going to give you a quick example to understand how it works. And as we go through this presentation, you'll see a better example. So let's say there's a $100,000 loan and you spent $70,000 on payroll costs and spent $30,000 on non-payroll costs, okay? Well, $70,000 obviously less than 75%. So there's going to be a portion that's not forgivable. So you can easily figure that out. Of course, you can easily figure it out by using the spreadsheet I'm going to show you, but this is the math to show you. Is you take $70,000 divided by 3 gives you $23,222. So rather than forgiving $30,000, you're only going to be able to forgive $23,222. Okay, so your total forgiveness is $93,333 rather than $100,000. In your application, they do it basically the same. They take 70,000 divided by 0.75, which gives you 93,000 the same way. So anyway, that's the math behind the way it works. So what is an eligible expense? So under payroll, you certainly got salaries, commission, tips, healthcare benefits, retirement contribution, other employee benefits. There's also been sometimes question asked, well, can I pay bonuses? And sure, you can pay your employees, again, employees. You cannot do any owners, or if you're self-employed yourself, more than your 8/52 of the 2019 income. But for employees, you can employ your employees as much as you want. If you want to pay them a COVID-19, extra pay, or for hazardous duty pay or whatever you want to call it, you can certainly do that. Non-payroll expenses, as we talked about, interest, rent, utilities, as long as they incurred prior to 2/15 or 2020. So these things we kind of already talked about. The non-payroll cannot exceed 25%. We talked about paid during the period or incurred and paid through the next regular billing cycle. And we've already talked about the covered period for payroll and the alternative covered period. So the 3 steps of actually creating an application is 75% must be for payroll. Compensation, this is where you get into your, did you lower your compensation by more than 25%? Because that now gets into a more complicated process of figuring out your forgiveness. Now, what you have to realize, compensation is your rate of pay. It's not the total dollars that's been paid. So if you paid somebody, we're paying somebody $10 an hour and you dropped them $8 an hour, they're still within the 25%. If they're at $10 an hour and they drop to $7 an hour, then they've been dropped by more than 25%. But if you have somebody at $10 an hour and they were working 40, but now they're only working 10, that doesn't matter. Even though it's more than 25% of what they were making, it's not their compensation. It's what their actual rate of pay is. And we also have to figure out what your number of full-time employees is, which we're going to show you in a second here. So the application process, I'm just going to jump through it, is you've got the calculation form, you have the PPP Schedule A, and you have the PPP Schedule A worksheet, and then you have an optional form that you can fill out, which is called the demographic information. So you're really talking 3 pieces of paper that you fill out to do the application. So when you start looking over, it's not as difficult as it seems to fill out the application. The difficult part is getting all the data together from your accounting systems and places like that. The application itself is going to be pretty simple. So you're basically going to start with your Schedule A worksheet. Then you're going to do the Schedule A, and then from there, it rolls over all the data over to the calculator form. So this is what the calculator form looks like. It has a top part with its general information and then the calculation at the bottom. So at the top, you're going to have your information such as your loan, your business and your contact information, and basic information that is readily available to you. The bottom section goes into the calculation. So the next page has to do with signing off that you agree that all this stuff was correct, it was needed, that you didn't pay too much money, you didn't go buy a new car, you didn't go to Hawaii or anything like that. So you have to basically sign off that all this stuff is true and correct, or they will come after you. So just make sure you read through that before you sign off on all these little things. So is it complicated? Well, as you go through this, you'll see it's not that difficult. It's getting the data together is the difficult part. So the first thing is line 1. You're going to enter the total eligible payroll costs. And this comes from your Schedule A, which we'll show in a second. Line 2 is the amount of business mortgage interest payments during the covered period. Line 3 is your rent or lease payments on real property. In line 4 is your utility payments. Okay, so far we've gone through the first 4, pretty straightforward. Line 5. So line 5 has to do with if you lowered your rate of pay by more than 25%. What I'm seeing is this is not happening, and most likely it probably will not happen. So I'm not even going to cover it. It's in the presentation here. You're welcome to go through it if you need it, but for the most cases, it's probably not going to apply to 99% of the businesses. So the next part is the Table 1. So this is the Schedule A worksheet. So you're going to have Step 1, which is the Table 1, and this is for employees that were paid less than $100,000. So in this case here, you're going to list the employee's name, the identifier, cash compensation, and I'll show you in a second how it works. Table 2 is if you have employees that were paid more than $100,000 in 2019. Again, make sure you realize this, as it says, this is not for owners. Owners are not to be listed on this chart here. And the bottom part has to do with your safe harbor reduction. They ask you the number of employees you had prior to February 15th, the number of employees you had between February 15th and April 26th, and the number of employees you have of the June 30th. Of course, this application could change if the law changes. So this is what the Schedule A looks like up front. So cash, complete the schedule. Cash compensations we talked about. It's the gross wages, gross commissions, paid leaves, et cetera, et cetera. Again, no employee can earn more than $15,385 in the 8-week period due to the $100,000 cap. Non-cash compensation is going to be the health insurance contribution, the retirement plans, employer state and local taxes, et cetera, et cetera. Again, this does not apply to owners of the company. So what is a full-time equivalent? So a full-time equivalent is based on 40 hours a week. So the simple method is you figure out what 40 is. So if it's 40 hours divided by 40, you got a 1 FTE. And I gave you a couple other examples. 38 divided by 40 is 95. 24 divided by 40 is 0.6. Okay. So there is an alternative method, which I'm not sure who would use it, but who knows, it might. It basically says that if you have someone who works 40 hours, they're a 1. If they have somebody who works less than 40 hours, they're a 0.5. Where it might make sense is if you have a bunch of employees that are working, 10 hours a week or something like that, and less than 20 hours a week, then that's when it would make sense. But for most businesses, it's going to be straight up just whatever the number of hours of average divided by 40. So the safe harbor has to do what we talked about previously about bringing your employees back to by June 30th to the amount that was in effect prior to February 15th. And this helps you bring your numbers back up to get full acceptance. Again, this could change to December 31st, but for right now it's June 30th. So another notable exception, this is what we're talking about when we talk about the VEC, even though the VEC is not required as part of this. So if you have an employee that you like to bring back or multiple employees you want to bring back, say, hey, Joe, I need you to come back to work. And they go, well, I'm not really sure I feel comfortable coming back or whatever else. Then what you want to do is make that a written offer and send it to them. Now, it'd be good if they signed off and said, I don't want to come back, and they send it back to you, but most likely you won't do that. But the best part is if you just create a written offer and then they refuse to come back to work, maybe you have an email, maybe you document it through a phone call or whatever else, then that does not go against you as part of your FTE, and you can actually place it into what they call an FTE exception box. It also applies to employees that were fired for a cause, they resign or requested reduced hours. Let's say somebody was working 40 and they only want to work 20 now, then you can claim that as a FTE exception. So we're back to line 5, which we're not going to talk about because this has to do with the dropping of the hourly wages. So this is the covered A work. This is the covered, the Schedule A worksheet table 1. This is for individuals that are going to be less than $100,000 in income on an annualized basis. So you have what we call an employee identifier. You can use the last 4 digits of the SSN. That's an easy identifier, as probably as anything is. So the cash compensation is going to be the sum of all gross salary, wages, tip, commission, leaves, et cetera, et cetera. Then you're going to figure out what the average FTE is. So that's going to be the average number of hours divided by 40 during that time period. So this is where it comes in to do math, is figuring out during this 8-week period, how many hours per week they work, and divide that by 8, and then divide that by 40, and that kind of gives me, is it a 1, is it less than 1, et cetera, et cetera. And then the salary, hourly, wage reduction, again, that's not something we're going to talk about, but if for some reason you did, this is where you would enter it. If you didn't have any salary or hourly wage reduction, you just put 0% in there. So we're not going to talk about this part because this is the reduction, but it's available to you to look over. So the FTD reduction exception. So this is where we're talking about if you have somebody who asked to come back to work, but they can't come back to work, or decide they don't want to come back to work, or refuse to come back to work, but you've made the documentation of it, then you can put in there average FTP exceptions at the bottom there, and then that will add back into your average FTEs. So that will help you in your mathematical formula. So once you've completed the table, you're going to summarize all those boxes: the cash compensation, the average FTE, and the salary wage reduction. And you'll see where these boxes here, 1, 2, and 3, flows back over to the forms. So this is for the people who are made more than $100,000 in 2019, or divided out, well, they had annualized more than $100,000 for any pay period in 2019. And again, you would just enter the same information, sum it out, what's their average FTP and their cash compensation. So the one question they're going to ask you is what is your chosen reference period? Because that's one of the things you have to use. So the reference period is saying, okay, what's my average number of FTE employees during the period of February 15th, 2019 and June 30th? Do I want to use the number that's between January 1st, 2020 and February 29th? Or if I'm in Caesar employees, I have other options. It's your choice. And obviously, you're going to pick the lower of the two, because the lower the number, the better it is to make sure you reach the number that you're looking for. But it's your chosen number which one you want to pick. But you do have to have that number available to you. So now here is your PPP Schedule A. So it looks like a lot going on here, but it's not too much. We talked about Table 1. So you got box 1, 2, and 3, which just is entered on line 1, line 2, line 3. You figured out Table 2, which you may not have a Table 2, but if you do, then now you figure out what line 4 and line 5 is. If you have health insurance, retirement, local state employment taxes, then that's what's going to go in line 6, 7, and 8. Owner compensation, it's going to go in line 9. Line 10 is just basically taking your calculator and adding stuff up. Line 11 is your FTP during the chosen reference period, which we were just talking about. So once you've determined what that period is, you put your number there. And total, so number 12 is just taking line 2 and 5 and adding together. And if you have no reduction, then you're going to have a 1 listed there. If your line 12 divided by 11 is less than 1, you would put it there, and there could be a part of your compensation or part of your loan that's not forgiven. So seems pretty simple so far, doesn't it? Hope so. All right, so now we're back to the front page. So line 6 is basically adding steps line 1 through 4 and then subtracting line 5. So again, this is just basic math. Line 7 is the reduction quotient, which you're going to take from the PPP line schedule, line 13 that we just looked at. So line 13 there is just going to go right on line 7. Line 8, more math. Line 9 is the amount of your loan. Line 10 is taking your payroll costs, which is line 1 divided by 0.75, and that's going to give you your payroll cost requirement. And then line 11 is your forgiveness amount, and all it does is looks at line 8, looks at line 9, and looks at line 10, and whatever one's the lowest is the winner. And we're going to show you an example here in a minute to make it a little bit more sense. So documentation, which is going to be extremely important. Again, each bank may require more or less, but for payroll, you're certainly going to have bank account statements. If you're using third-party payroll services, certainly you're going to have payroll journals, anything that you can think of that shows compensation reports, payroll journals. If you're a sole proprietor, it could just be checks written to you, and maybe that every check you need to write is you need to physically write yourself a check, and at the bottom of the check, it says owner's draw, the same thing for partners or something like that. So you're documented rather than doing transfers and things like that. You've actually got a documented check that says what it's for. Tax forms could be any kind of payroll tax forms. It could be 941s, your VEC reports, anything that shows that you paid a certain number of people. The VEC and the 941s are great because they show the number of employees that were paid and who they were and the amounts paid. Unfortunately, 941s are not going to cover the periods of everybody, and you may not be able to use them, or you may have to wait in order to file your report because you got to wait till the next 941 is filed. And we talked about those. All right, so for non-payroll, it's going to be the same thing. If you have mortgage interest, you're going to have to show statements from the bank showing the amount of interest. If they show you an invoice, it shows interest this month versus principal. If you need to show to make sure that you're showing that this particular mortgage was in place prior to February 2020. If it's a lease, you need to make sure it's in effect prior to 2020. Show a copy of the lease showing it's dated before then. You're probably going to have copies of checks or show entries from the bank showing that checks were paid for particular covered expenses. It's basically invoices and checks to show the invoices show that there's a bill, the check shows it was paid. And just make sure it's dated either in the period or within the period that would normally be paid after the end of a period. In other words, it's being paid in the normal billing cycle for you. So we talked about things that once you complete it, you're required to maintain all this stuff for 6 years. So after 6 years, for 6 years, you're going to have to keep these worksheets. You're going to have to keep the tables, the application, any job refusal things that you have. Basically, you want to pack up everything that you use for documentation and stick it in a box or scan it and put it somewhere that you can easily get a hold of it if you need to, if you have to justify it in the future. And we already talked about health insurance and retirement benefits not being included for sole proprietors. The last page is a demographic page, which again is an optional page. It's one if you want to fill it out for all the owners. It's nice if you would fill it out because that way they can report information to whoever they're supposed to be reporting to. So that's the application. I'm going to show you an example real quick, and then I'm going to show you a spreadsheet we got, and then we're going to go into some questions. So hopefully we got time to do some questions. So, and this is an example I actually stole from another presentation from the National Development Council, which I'm part of, so that's okay. So anyway, this is, let's just say this lady is Rose. She operates Rose Flowers in Cleveland. She has a monthly payroll of $8,000. She applied for and received a PPP loan of $20,000. And she received that on May 22nd. She utilized the covered period and spent those monies on payroll through July 16th. So that was her 56 days. She has 4 employees at application. She didn't get a EIDL loan. She, during the covered period, she paid $18,000 in wages. She paid $1,000 for health insurance. She paid $500 in retirement, $500 for state and local taxes, for a total of $20,000. She also had $3,000 in rent and $1,000 for utilities, and did not reduce wages for any employees. All right, this is probably going to be an easy one because she used all of it for payroll, but we're going to still show you anyway. So the top of the page just shows you filling out the business information. It's going to show that employees at the time of application was 4, employees at time of forgiveness was 4. She didn't get a EDI advance grant. Again, that's the advance. It's not a disaster loan. Disaster loan has nothing to do with this. If it's an EDI advance, it will be subtracted from the actually amount of money that's forgiven. Her payroll schedule is weekly, and her covered period is from 5/22 to 7/16. So this is a list of her employees. It shows her cash compensation. And this particular presentation is a mistake because where it says average FTEs, that should say 1,111 or a total of 4, not 40. So anyway, that should be an average FTE of 40. So what happens is now we're carrying over line 1, which was $18,000. We're carrying over 4, which is the average number of PPP FTEs. There was no reduction, so there was 0. There was no kind of over $100,000 compensation. And she paid $1,000 for health insurance. She paid $500 for retirement. She paid $500 for taxes. So she adds all that up and comes to $20,000. Her average FTP during the chosen period was 4. Her average FTP adding up the 2 was 4. So it basically gives her a 1, which basically means there's not going to be any reduction in the loan. So now this is the actual, that's what the Schedule A looks like. So this is going to be the actual calculation form, which is the first page. So it's going to show the payroll cost of $20,000, your business rent, lease payments $3,000, utility payments $1,000. So it's going to give you a total of $24,000. Her quotient from line 13 was 1 because she had the same number of employees. So she added up, line 8 is basically adding up 6 and 7, which gave her $24,000. Well, she only got a loan of 20. In payroll costs, she was allowed to do up to $26,667, but she only spent 20 because her loan was only 20. Therefore, the lower of those 3 amounts was $20,000. So her loan forgiveness is $20,000. So that's the way that works. So now let me go to the spreadsheet that I will be sending out. I figure out where it's at. No. All right. I'll be right back. All right. Hopefully everybody sees my spreadsheet. There we go. And I will be sending this out to everybody so you can see. So this is the, at the bottom you'll see it's got 3 tabs, just like the sheets that we just went over. There's an instruction sheet here. It kind of tells you how each sheet works. This is the forgiveness calculation tab, the PPP Schedule A, the Schedule A worksheet. And if you have employees that drop below the 75%, there is a separate tab in here that you can use to work on. We're not going to go over it because I don't think most people are going to do it. So the best thing to start off with is the Schedule A table. And we're just using the ones that have less than $100,000. So you can scroll down, and I just put employee 1, 2, 3, and you can obviously put people's names in here. Identifier, you can use an employee identifier. You can use the last 4 of their social security numbers. And I'm going to increase this a little bit so it's a little bit easier to see. All right, hopefully that's a little bit easier to see. So now what we're doing is under the cash compensation, we're going to list the dollar amount of cash compensation that they receive. Again, this is the cash compensation. Because remember on the form, we add in retirement, we added in health insurance on the form itself. So this is strictly for the employee. I also figured out what their average FTE was during that period. So I added up the weekly hours that they worked for the 8-week period divided by 8, and it kind of gives me what the number of FTEs are. So I've kind of added these up. So we're not having any reduction in hours like we do over here. So none of these are reductions in hours. So everybody's paid the same. So now it comes down to box 1 is 58,000. We have 5.2 for average FTEs. So we're good to go. Down here is box 2, table 2 for the more than $100,000 employees if you have those. And in part 3 is where we talk about the safe harbor, that you have to have the same amount of employees as of June 30th that you did on February 15th, or you may be reduced the amount that you get forgiven. Of course, that could change to December 31st, but right now it is June 30th. So the first box asks you, what's the number of FTEs that you had between February 15th and 26th? The second box asks you, how many did you have before February 15th? And step 4 is, how many did you have as of June 30th? So I've just plugged in some numbers. These numbers will now flow over to our Schedule A. So let me again increase this. So you'll see that the cash compensation flows over to here to 58,403. It flows over to 5.2, which we came up with, which is the number. We didn't have any reductions, so there's 0 there. We didn't have any Schedule 2 or Table 2, which is the more than 100,000. We put in here, now we enter in the amount of health insurance, we enter in the amount of retirement plans, we enter the amount of state and local taxes. The next box we enter is the amount of, if you haven't figured it out by now, the yellow boxes are the ones that you enter, the blue boxes you don't do anything with. So we enter in the amount of owner's pay that was paid, and I just put in 15,385. That's the maximum an owner can get. So now it's going to add up all the numbers to 79,888. At the bottom, it does the formula for you. So at the bottom on line 13, it shows number as 1, so you get 100% of forgiveness of what you have. So now this is going to flow over to page 1, which is the actual calculation form. So in this case here, I'm saying that they got a $5,000 EDIL or disaster advance. Now again, not the loan, it's an advance. So now they've got total payroll, which just came from the Schedule A of 79,888. They have mortgage interest of 14. They have rent for 17. They have utility payments for 16. All of that adds up to 126. So they didn't have a reduction quotient, so it still carries down here to 1. So they can claim up to 126. Unfortunately, their PPP loan was only 110, but they also had to do 75% payroll. So what with this number here, this 106 is taking the total of 79,888 divided by 0.75, which is 106,517. And as it says here on line 11, it's the smallest of lines 8, 126, 9, 110, or 10, 106, gives you 106,517 is the forgivable amount. Since they also received $5,000 as an advance, therefore they're only going to get forgiven for 101,517. So that's the way this thing works. Real quick, I'm just going to show you a change. Let's just say you only had 5 people that came back. And so now you've got a formula of 0.87 instead of the full 1. So in this case here, 126, which were the total of all the expenses, they could only be forgiven for 109,969. in this case here, it didn't matter because their payroll was still 106 was still their lowest number. So even though they did have less employees, it didn't matter because they didn't spend enough on payroll to get the number they needed to be forgiven for more than the 75%. So that's the way this form works. So anyway, I think since we are running out of time, I'm going to go ahead and answer some questions. It looks like there's a billion of them in here. Amanda, I don't know if you're on here, if you've already looked at them, if there's ones in particular.
Yeah, I will, Tom. I'll go through here and read you the ones that we have for you to answer.
Go for it.
Let's see. We have several questions around people paying. It's really two questions. Some people are paying payroll once a month, and some people are paying payroll twice a month. And so let's go back to the basically biweekly is not necessarily the same thing as bi-monthly, but Meredith asked in our chat and says, if we have a 24 pay periods a year, she said, we're not eligible for this shift. And that was early on in like your second or third slide that you were going through.
Well, that's correct, because they distinctly say bi-weekly, which means 26 pay periods a year, not bi-monthly. So that they intentionally stated bi-weekly in all the forms. So if you're bi-monthly, you cannot go for the alternative. It still doesn't mean you can't take advantage of paying additional money through your PPP, because again, it's based on the date of incurred and the date paid. It just doesn't allow you to go outside and pick an alternative date, which you could always convert to a twice a month for the short time period. I guess. I don't know why you couldn't do that.
Another one we have here is we have someone that's concerned about like having to close their business, and would the loan be forgiven if they close their business after that 8-week covered period?
The way, again, there's a lot of unknowns in this whole process, and you never know what's going to happen when you submit your application and the SBA looks at it. But the way I think it would look is if the business is operating after the 8-week period and you turn it in as an operating business and you close after that, that's out of the realm of the process. Now, if you close during the 8-week period, I think you would run into a problem because you would probably lose a lot of the forgiveness because your formulas are going to be messed up on your FTEs and stuff.
Okay, I think I answered this question in chat, but I just wanted to bring it to everyone's attention because it's a question we get a lot of, and it's paying bonuses during this time if you need to work down some of your money. And Tom, certainly correct me if anything I say is incorrect here, but if bonuses are a normal part of your business operations, you can do that. You can pay bonuses. If they're not, and you're just trying to pay bonuses to run down the money, I would not suggest doing that. But you could potentially pay overtime to employees, or there's other ways that you could use that money for your employees without calling them bonuses. So I would only do that if that's a normal part of your operational process.
Yeah, what I would recommend if you're going to do something like that is just increase the rate of pay during this time period and call it, hazard pay or whatever. That way it's kind of part of your scheduled payroll system. Again, owners would not fall under that territory because you're still tied back into that 852nd number.
Debbie asked, are severance payments a covered payroll expense?
For employees, yes.
Mm-hmm. Let's see. So I got this question is on here twice, or the similar situation. So let's walk through this one, and I think it'll answer the others. who had this as well. And this again goes back to kind of the different payroll periods. But Teresa says that they've received their PPP on April 14th and wants to know if they can claim the full amount of April payroll and then the full amount of the May payroll, since their 8-week period is up on June 9th. And there's very questions just like this, just with different dates. And so I think we could talk about clarification around, you know, what those payroll periods really are for that 8 weeks based on when you're paying your employees.
So if you've got a payroll system set up, again, this is the way it's interpreted now. And I've been through multiple of these seminars, and they've all kind of taken the same position.